So you've heard me go off in other videos about like people, these headliners, these talking heads that try to predict mortgage rates, right? Like, Fannie Mae says that mortgage rates are going to be 4.5% by next year and blah, 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 blah. The reason why I rail so hard against these things is because mortgage rates are really hard to predict. And the reason why mortgage rates are really hard to predict is because basically what we're all trying to do is predict human behavior. Where it starts is in the bond market. So the mortgage rates are determined by bond traders. They trade mortgage-backed securities or mortgage bonds based on what the Federal Reserve is going to do. And right now, as you've all seen in the headlines, the Federal Reserve continues to increase interest rates, and they're doing so at a really rapid pace, a pace that we haven't seen in decades. Why is the Fed doing that to create this gyration in the bond market? Well, the Fed is doing that because they are trying to tame inflation. And they're trying to tame inflation while also not trying to destroy the economy and send it into a deep recession. So there's this balancing act that everyone's trying to do. What the Fed is doing is they're raising rates to try to pull money out of the market. So when the interest rates go up, just without getting into detail, it pulls money out of the markets because people aren't borrowing, money's not as easily accessible, it's too costly, et cetera, so it's staying out of the marketplace. Inflation is nothing more than too many dollars chasing too few goods. The economics 101. The reason why it's so unpredictable is because the Fed raised their rates based on, let's say, inflation, right? That's the big thing. Everyone's, the Fed's gonna raise rates. It's all about inflation, it's all about inflation. Okay, well, in November, we saw a really good inflation reading. We saw inflation come in below expectations, which caused the bond market to trade in such a fashion that lowered mortgage interest rates. Why? Because they were trading on the future bet that the federal government was not going to raise rates as quickly as they originally had thought because they got good inflation numbers. The bond market is all about trading in future anticipation of what the Fed is going to do. So how easy is it to predict what the Fed is going to do? Well, if we look at inflation, I think it's pretty straightforward that we should start seeing inflation start to decelerate because prices today aren't going up nearly as fast as they were going up last year. A lot of the reason is because they increased rates. But here's the thing is we just don't know. As the Fed increases interest rates, it's harder to borrow money. And so if big corporations can't borrow cheap money, then they can't bring in labor force to sell their goods and services. So ideally, their revenues would go down, their stock prices drop, then they have to do layoffs in order to balance these things out, which should affect the job market, which should affect people being able to spend, which should affect inflation in a positive way, meaning make it go down, right? Well, that's not always the case. So the Fed has been jacking up interest rates. My friends in the real estate industry and the people who are buying and selling have felt the slowdown. They've felt the grind in our industry. My friends in the car industry, we have felt the effect of these increasing interest rates, but not everybody has felt it. In fact, the jobs report that came out recently, 263,000 jobs when we expected 200. Wage growth was 5.1% year over year when they expected, something like in the high fours. Basically what this means is that the Fed is trying to create an environment to slow down the pace of spending, to slow down the pace of the money in the market and things of that nature. And a strong jobs report and high wage increase, also things like the Institute of Supply Management, their data point shows that businesses are doing better than we thought they would be doing. And so the point is the Fed is going to look at all those data points and say, you know what, if people have lots of jobs and lots of money, they're still going to be able to spend high prices, thus inflation, the prices are going to keep going up if people have the money to pay those high prices. So the Fed sees inflationary potential based on these other data points. So now all of a sudden the bond market reacts in another way. When the strong jobs report comes out, when the strong ISM report comes out, these other little data points that come out, the bond market thinks, the Fed is going to look at this and raise rates. So they trade their bonds in future anticipation with what the Fed is going to do. With these economic data pieces coming out every single week, the bond market is trying to guess what the Fed is going to do. And every time a new data point comes in, they think, the Fed's going to do this, so we're going to trade bonds like this. The Fed's going to do that, so we're going to trade bonds like this. And these are the things that make the mortgage rates go up and down with such volatility. And that's why they're so hard to predict, because we could sit here and say, okay, Fed raises rates, corporations can't borrow money, they can't bring in workforce, stock prices are going to go down. This is going to lead to things like layoffs in order to be profitable, to raise their stock price. And so the point is there's going to be less money supply, less jobs available, and less wage growth, and those things are going to combat inflation. But when the interest rate increases haven't done that yet, then the fear becomes, the Fed is going to continue their tight monetary policy until those things do happen. So that's why they're impossible to predict, because there's a million different data points. Black Friday and Cyber Monday, we saw some of the biggest spending in the history of those 2 days. So people still have the confidence in their economic situation to go spending and consuming, that is an inflationary indicator for the Fed, which means they might raise rates faster or they might not. These things are impossible to predict because there's a million different data points that they go off to make their policy decisions. That's why, as always, it's important to make buying decisions in an environment when it's good for you, how it's good for you, at your pace, on your budget, in your terms, in your time. Because if we look at these buying and selling real estate decisions over a long-term time horizon, what happens in the bond trading November, December, January of right now, really over the long-term 5, 7, 10 years down the road, the likelihood of you coming out ahead is pretty high. So we need to make sure that whatever moves we make right now are less dependent on interest rate and more dependent on, is it the right time for you? Is it the right price for you? Is it the right budget for you? And things that basically affect your unique situation.